This video will talk about monetary and fiscal policy, the two tools that are used by governments in an effort to run their economies at the full employment level. So if we use this ruler as a stand-in for aggregate demand, what a policymaker or government wants to do is not run the economy here because the equilibrium is in underemployment or a recession, and you don't want to run the economy over here because over here you're overheating and causing inflation. You want to hit this full employment sweet spot, and at that level you've got pretty much everybody working, but prices aren't rising too rapidly. So it's kind of the Goldilocks place, right? Too hot, too cold, just right. Okay, so the two tools that policymakers have at their disposal to make those adjustments to the aggregate demand curve are, one, monetary policy, and two, fiscal policy. Now, how to keep those two straight, one from the other? Look at the first four letters. In monetary policy, the first four letters basically are almost all of the word money. And the price of money is interest rates. Interest rates. The first four letters of fiscal policy are fisc, and fisc was the term to describe the Roman emperor's treasury. So back then, of course, money was gold, so it's basically the gold chest of gold that the Roman emperor had. And so what adjusts that fisc is basically two things. One, how much the government spends. So that's money going out of the fisc. And two, taxes. And that's money going into the fisc. Okay? So fiscal policy is government spending and taxes. Monetary policy is interest rates. All right, now, there are basically two situations you can have where the economy is not running where you want it to run. Either it's running too slow down here, or it's running too fast up here. We'll start with, what do we do if the economy is running too slow? And if the economy is running too slow, you need to do, just to separate the two, you need to do an expansionary policy. And the key to expansionary fiscal and monetary policies is what you're going to try and do is give people more money to spend. So, what does that mean? One, for monetary policy, cut interest rates, decrease interest rates. When you cut interest rates, people suddenly find they have more money in their pockets. They can go out and spend that money. Let's say they've got a car loan. Their car loan becomes cheaper. Then they make their monthly car payment. It's lower, and they've got some money left over, and they go and they spend it at Starbucks. Or their mortgage goes down. They refinance their home. Now they've got a couple hundred extra a month, so they go someplace fancier than Starbucks. Another place is credit card debt. So as interest rates are cut, their credit card payments, their minimum monthly payment falls, and they go to the shopping mall and spend more money. All of those things drive the aggregate demand curve to the right and boost the economy. So cut interest rates for monetary policy if you're trying to make the economy expand and go faster. For fiscal policy, it's the same thing. You want to put more money in people's pockets. So if it's government spending, then what you want is for the government to spend more money. Increase G equals government spending. So the government might, let's say you're here in this situation, the government might give more money to retirees than they spend it. Or you give more money to welfare, they spend it. Or you build roads. The money comes out of the fisc, out of the treasury, and the road builders make money, and then they in turn spend it. Drives the economy faster. The other alternative is you can cut taxes. So the government is reducing the taxes on people. So that means that when their paycheck comes in, less is taken out of their paycheck. They find they've got more money in their pockets. Bang, they spend it. And so in that way, you also drive the aggregate demand curve to the right. Now, exactly the opposite applies if you're in a situation where the economy is suffering from inflation and it's overheating. You just want to do the opposite to create a contractionary policy. We'll put those over here, contractionary. So for monetary policy, you increase interest rates. When you increase interest rates, suddenly your credit card minimum monthly payment goes up, your mortgage goes up, your car payment goes up, you have less and less money to spend, so you stop spending it, and you drive the economy this direction. For fiscal policy, you can see all of this is just the reverse. For government spending, you cut government spending. Okay, you cut welfare programs, you stop building roads, all that kind of stuff, and the economy is going to slow down. Or you can simply take the money directly away from people by increasing taxes. Same thing happens. You increase taxes, people have less money, and bang, the economy slows down. So those are the tools, monetary and fiscal policy. Monetary is moving interest rates up and down. Fiscal policy is adjusting government spending and taxes. If you want the economy to go faster, cut interest rates, increase government spending, or cut taxes. If you want the economy to go more slowly, increase interest rates, cut government spending, raise taxes. That's how it works.